James McCaughan is the CEO of Principal Global Investors. He's also president of Global Asset Management for the Principal Financial Group. Welcome to you, Jim. Great to have you in studio today.
Great to be here. Thank you, Laurie.
All right, so the markets, as you know, right, have been depressed for a couple weeks here as we monitor Greece and the other woes out of the Eurozone. These issues are still on the table, so what's driving the rally the last couple days?
I think the market is getting a hold on the fact that the fourth quarter results were good. Not only were earnings ahead of estimates, but so were revenues, which is where the biggest question was. You know, it's all very well that profits are good, companies have cut costs, but actually the top line's been quite good, which backs up the recovery story on the economy.
The stat I have for you, I pulled from the terminal here. 3/4 of the S&P 500 companies have reported earnings that have beaten estimates. And you mentioned the top line, and that was the challenge in the prior quarter. So how much bullish ammo, if you will, is there?
Well, the market has obviously come up a long way from the bottom nearly a year ago. And I think at this stage of the recovery, you're going to see a choppy recovery. Hey, we're seeing that so far this year with Greece and with the Chinese tightening and the things that have slowed the market down. Congress, of course, has got some issues for the market. But I would still expect the market to be up on balance by 10 to 20% over the whole year.
We just heard David Rosenberg warn of a return to volatility in 2010. So given your forecast, how hard is it going to be? How many swings are we going to have to endure before we get to those gains?
Yeah, it's really hard to tell. You know, we've really had three big headwinds for the market this year. One has been Greece. One has been the Chinese tightening, which affects the growth story in Asia. And the other has been uncertainty about what Congress and the administration are going to do. There may be others. You know, last fall it was Dubai. It's kind of unpredictable where the bumps in the road come from. But at this stage of the market, there will be bumps in the road. But it's very important for the longer-term investor to be accumulating and keep confidence in the economic cycle.
And speaking of confidence, President Obama trying to instill some confidence today on the anniversary of that stimulus that helped the economic recovery. Can we get a sense now, at least going forward, that maybe the economy might be able to stand on its own without a stimulative effect?
I would believe that, and indeed I think that whatever Washington does now runs the risk of slowing the recovery in jobs. The reason I say that is if they spend more money, ultimately there's going to be more tax out there, and the deficit is something people worry about. We're very connected to small, medium business right across the United States. And this has been the first recession since the 1930s when they've shed labour. The reason they're not adding labour yet in this recovery is uncertainty about their taxes, their healthcare costs and regulation.
So do you have some confidence that the administration might be able to adequately help small businesses, as the president said the other day?
I would hope that they'll help them by not tangling them up in taxes and regulation. If they do that, the economy will create quite a lot of jobs over the next 2 years.
All right, so all that said, how do you put your money to work right now? What sector should we be paying close attention to right now?
Interesting question. I'd start by saying what I'd avoid. And I think longer term, I would have a lot of fear over the healthcare sector. The fundamental economic argument, we spend too much on healthcare, 17% of GDP. Most other developed countries get a better result from 9%. So over the next 3 or 4 years, regardless of what happens to the current bills, the medical system has got to become more economical. I'd also avoid commodities where there's oversupply. The areas I like include financials, technology and manufacturing. The US is having a manufacturing boom at the moment. The trade deficit is right down. That's one of the drivers of growth.
But you say you like financials. Is the Volcker rule, if implemented, would that put the brakes on growth?
It would put the brakes on growth, but it would lead to a more stable financial system. And ultimately, if the Volcker rule is well executed, one that is better trusted by the investors. I think the problem at the moment with proprietary trading, it's not only that it makes banks less safe, which is what the coverage of the Volcker rule has really focused on. Proprietary trading and leverage also are seen as something that's against the interests of the long-term investor. If proprietary traders front run or do highly active things in the market that create volatility, I do think that a return to a less frenzied proprietary trading background under the Volcker rule might be a very good thing for the market longer term.